The likelihood of an end to the US debt crisis may mean more pain for Australians. The ANZ Bank says the deal clears the way for higher interest rates. The RBA meets tomorrow on rates, with homeowners anxiously awaiting the outcome. But as finance correspondent Philip Lasker reports, soft economic data may stay the Reserve's hand.
Mechanic Adrian Sarno knows how to keep things humming along, and he knows what usually happens when interest rates go up.
Servicing can be delayed, as people overrun their services.
So he has some advice for the Reserve Bank if it's thinking of raising rates.
With what's going around the world at the moment and what's making headlines, I don't think it's really needed at the moment.
Manufacturers, some of whom supply Adrian Sarno with spare parts, are screaming more loudly.
Further interest rate rises on top of what's already there, on top of the high dollar, on top of the fiscal contraction that's going on, will hit the industry with a sledgehammer.
But the sledgehammer may have already hit. A gauge of manufacturing activity slumped to a 2-year low in July as jobs and forward orders dried up.
Generally a very, very tough month for manufacturing.
Many of those manufacturers supply the housing industry, where new home sales showed their biggest monthly fall in 5 years. It might get tougher because some analysts say the looming US debt deal clears the way for the Reserve Bank to turn its attention to rising inflation.
It's a close decision, but the inflation numbers this past week led us to the view that the RBA is most likely to move on rates tomorrow.
The world economy is very uncertain. And locally, I think the Reserve has been surprised by how weak the retail, the manufacturing, construction sectors are. So I think we've got time.
If the Reserve Bank gets its interest rate decisions wrong, the vehicles in Adrian Sarno's workshop won't be the only things stalling. Philip Lasker, ABC News.